We've shut down our borders, thankfully, but in the short term, that's not very good for labor force and population growth. When you have a plunge in GDP growth like that into the negative, and that's one half of a recession, so 2 quarters back-to-back negative GDP growth would be a recession. So you'll have an official NBER recession, in my belief. Why are Treasury yields soaring when they should be falling? The answer is that we have not conquered our inflation problem.
Now, Trump, he said the other day Powell is a loser. Do you think Powell will end up caving to Trump's rate cut pressure?
The fact of the matter is the level of prices have rendered the middle class on life support. We've never had 3 bubbles existent at the same time. We had the NASDAQ bubble in isolation, and then we had the housing bubble in isolation, but now we have the housing bubble, and we have a credit bubble, and we have an equity bubble, all existing concurrently. So we are an insolvent nation.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, welcome back to another pod. Things are getting pretty wild in the markets as stock indices and stock markets don't seem to just correct anymore. They seem to break overnight. 2 weeks ago, the 10-year Treasury yields surged 50 basis points in days, rallying investors and the White House. Gold has smashed through $3,400 an ounce, yet another record, and Trump is going wild with tariffs. The Fed is cornered between sticky inflation, low unemployment, and a mountain of rolling U.S. government debt. If you're trying to figure out what may come next, like I am, you'll want today's guest in your corner. Michael Pento is the founder of Pento Portfolio Strategies and has spent 3 decades at turning market chaos into actionable signals. His inflation-deflation economic cycle model rotates capital the instant the economy flips, and he says the economic recession has already arrived. A former NYSE floor trader and author of The Coming Bond Market Collapse, Michael doesn't peddle doom or celebrate market meltdowns. He just follows the data. So grab your notebook, maybe pour something a little stronger than coffee, and let's get into it. Michael, welcome to the pod.
Thanks for having me on, Aaron.
We're in an environment where, Treasury yields spiked overnight, it seemed, which is in direct contradiction to what Trump wanted. Gold is ripping to new highs, and the Fed seems to be boxed in, and U.S. equities are starting to crater. From your vantage point, are the U.S. markets appropriately priced right now amidst all this uncertainty, or do we have potentially further to go?
Depends on what you define as appropriately priced. I mean, if they wanted to go down to where they should be to be a median historical value based on the total market cap of equities as the numerator and as the denominator GDP, they'd have to be, S&P would be around 3,000, not where it's at. I think 5,200, I think, is around where we are today, 52, 5,300. It's only down about 15% since the February 9th high. So only sounds inappropriate when people have been inculcated and like crybabies thought that, hey, the market goes up 20% every year, doesn't it? Don't we just borrow $6 trillion every time we have a hiccup? And the Fed will monetize $5 trillion of that $6 trillion. The private banks will do the rest. And home prices go through the roof and stock prices go up inexorably. So isn't that the way it's supposed to work all the time? We do have a new tool. It's called a fiat currency, and we can print it. And if we can print it, well, we can eliminate all recessions and all bear markets. Don't you know how easy that is?
So do me a favor, run me the math on that. So you say the S&P potentially fairly valued around 3,000 to 3,200. How do you come up with that number?
Well, if the total market cap of equities was 200% as a percentage of GDP, and it should be historically 100% of GDP, I'm assuming the denominator doesn't drop. I'm being generous.
Right.
I'm being generous.
Okay.
So at 3,000, the low 3,000s would be where I would think it should settle out. Of course, as GDP increases over the years, it'll go much higher. But if you ask me today, that's where it should be fairly valued based on the productivity of the nation. So GDP is a function of labor force and productivity, and that's how you get GDP. And by the way, we've shut down our borders, thankfully, but in the short term, that's not very good for labor force and population growth. Mm-hmm. And then you have Doge in town, which is wonderful for an insolvent nation. We need a lot of Doge, but that's not really good short term when 70% of all hires were either government employees or contractors that helps government employees. So yeah, we're going through some very rough times, and we have some illiquidity traps coming too. So post-COVID, what the Fed did immediately, which I thought was ridiculous for a virus, a novel virus, but certainly not one that was the bubonic plague, but we ended up printing $5 trillion. Even worse, $6 trillion of that, the onus was the Treasury, just spending money willy-nilly. And there's also loan forgiveness and forbearance measures that took place too. So when you add it all up, it's $6 trillion of helicopter money, and $5 trillion was monetized. What does that do to the long-term productivity of the nation? What does that do to the nation's insolvency? It expedited, pulled forward our insolvency condition. If you look at assets minus liabilities, total unfunded liabilities, we are an insolvent nation. And then you wonder why. Well, let me ask you a question. Why would, when we have GDP growth go from 2.5% to 3%, slightly above trend growth GDP, all the way down to something in the minus side, like minus 2%. I think it's minus 2.2%, according to the Atlanta Fed, Q1 GDP growth. When you have a plunge in GDP growth like that into the negative area, and that's one half of a recession, so 2 quarters back-to-back negative GDP growth would be a recession. I think Q2 will almost guarantee to be a negative growth. So you'll have an official NBER recession, in my belief. Why are Treasury yields soaring when they should be falling? And the answer is that we have not conquered our inflation problem, and we have not dealt at all with our insolvency issue. When you have deficits that are 7% of GDP, which is in peace times, and in times when there supposedly is full employment and robust above trend GDP growth, you have 6-7% deficits to GDP. So you haven't addressed that at all. And then you have the illiquidity issue too. So the reverse repo facility, you think about what the central bank does. They print something called Fed credit. It's part of the base money supply. So it's physical notes and coins in circulation, and it's Fed credit. And they printed $5 trillion of that, and they gave it to the private banking system. And what of course, did the private banking system do but help fund the government, the Treasury? So we have not dealt with our inflation problem whatsoever. As a matter of fact, one would have to wonder if we as a nation, have been north of the Fed's 2% inflation target for 4 years, and we won't get back to 2% or anywhere near 2% until 6 years. You would think we would be in the middle of a rate hiking cycle, but we are not. We are in the middle of a rate cutting cycle, albeit truncated and slightly attenuated because inflation is just not coming down to 2%.
Now, Trump, I don't care what anyone else's politics are, to each their own. I mean, he said the other day, Powell is a loser, quote unquote, and that there's virtually no inflation. Never mind, what we're seeing in our everyday lives at the grocery store and so forth. Doesn't gold's new record high directly contradict Trump's statement? He ought to know better. Why has gold surged so much if there really is no inflation? What's going on there? To me, is gold not a direct barometer of inflation, or is there more to the story there?
There's more to the story, Aaron. So first of all, just get the politics out of the way. People think maybe, Mr. Pento doesn't like Donald Trump. I voted for him twice, and I'm a libertarian. I thought the alternative would be egregiously worse than what we have now. But I don't think he's playing 4D chess either. He says there is no inflation. The fact of the matter is that the level of prices have rendered the middle class on life support. So if you look at the middle class, between the 20% and the 80% of earners, that's how we define the middle class. They have less net worth than the top 1% of earners for the first time in history. We have eviscerated and wiped out the entire middle class is on life support. I give Trump a lot of credit for trying to rebuild our manufacturing base and balance our trade. And so for that, he deserves a lot of credit. Gold loves falling nominal rates and falling real interest rates most of all. But something else has happened. First of all, we have a Fed, as I mentioned, that has a bias towards easing, even though inflation has already wiped out the middle class. That's where I was going with that, my anecdote there. So, the middle class can't afford a house. They're barely hanging on when you look at taxes and insurance. They're barely hanging in there. And that is the direct result of what the Treasury and the Fed has done. But given that Powell has missed his inflation target to the north for so many years and will miss it for 6 years as the minimum, why is he lowering nominal interest rates? Should be raising them. That leads to falling. So inflation is rising while nominal rates are coming down. That's falling real interest rates. That's the main driver behind gold. But there's something else happening too, which is setting it, way past, into record territory. And that is that foreigners are selling their trade surplus, which is kept. We have a capital account surplus. There's a trade deficit, current account deficit, capital account. I don't want to get into the weeds. Just basically, I'll say this. If China sells us a lot more stuff than we sell them, and they have excess dollars, what they could do is sell those dollars and buy renminbi and get a rising currency. They don't want that. So we have something called a capital account surplus, means China, all the other current account surplus countries, they buy our treasuries. They fund our trade deficit. They park those funds in dollars. Started with Russia, really, when the United States says to Russia, your wealth has been confiscated. We can confiscate your wealth now, arbitrarily, capriciously, by whim, by decree, by fiat. That started the snowball where foreigners are no longer willing, or at least they're more cautious, to park their current account surplus into treasuries and dollars. So now what we see with the trade war, let's just take China again, for example. If China has much less of a trade surplus to recycle into our currency and in our treasury market, what happens to the buying? Where are the bids? Where are all the bids going to go? The Fed is still in the process of QT, although albeit greatly attenuated. I think there are $5 billion a month in treasuries, and there's still $35 billion mortgage-backed securities, but there's not many of those maturing anymore. But they are not in QE anymore. So the Fed isn't buying. Private banks aren't really buying that much, and foreigners aren't buying. Just as a simple exercise, is they don't have the trade surplus to recycle into our treasury market. And then, if the trade war also means that China is more reticent to hold their wealth in U.S. dollars and in our treasuries, they sell. And when they sell the dollar, they are not going into renminbi, they're going into gold. It's a long-winded answer of explaining why gold is the recipient, or the new world's reserve currency, real and honest money, the only one that's ever existed, which is gold.
I agree. That's a great breakdown. Just following up on Trump, obviously this has huge implications, but do you think Powell will end up caving to Trump's rate cut pressure?
No, I don't.
Really?
No, I don't. I don't think he will. I think what he'll cave into is when the repo markets freeze and the credit markets freeze and you can't float commercial paper any longer. He'll do what every other Fed chair has ever done in the past. They'll act in arrears. They'll be late. Let's be honest. What happened in 2001? The Fed cut rates. They cut rates from 6.25% all the way down to 1%. Did that stop or save the NASDAQ from crumbling 83%? No, it didn't. Or from the S&P losing 50%. And Bernanke did the same thing in 2007. They started cutting rates, and they cut them from 5.25% all the way down to 0 by the end of 2008. And did that save the S&P 500? Not at all. It still went down 50%. It didn't even save the housing market. So Powell will cave in, and he'll be even later, Aaron, I think he'll be even later than he has been, or the Fed has been, historically speaking, because he has this problem with inflation that's really not been in existence before. If he were to cut rates now aggressively, proactively, I think the long end of the bond market would go berserk. I mean, prices would tank and yields would skyrocket. He cannot do it proactively. So it's going to be ex post, too late. The carnage is coming. It's happening now.
So in response to a crisis will be the only scenario.
Yeah.
So, I look back at 2008 and can it not be argued that, quantitative easing and their monetary intervention saved the economy? The U.S. housing market, for example, was obviously in dire straits. The Fed came in with QE, obviously monetary intervention of all sorts. Can it not be argued that they were life support for the U.S. housing market?
I don't think it can be argued against that. The Fed does what they always do. They counterfeit money, they counterfeit base money supply, and they artificially manipulate interest rates lower. That ameliorates the decline in asset prices, and it tends to boost the economy. It papers over, it inflates away the problem, but that's only a temporary solution, as we see what happened in the NASDAQ bubble. That's what happened in 2001 to 2003, but it laid the groundwork for the housing crisis. And then what they did again in COVID, to an extreme, laid the groundwork for a triumvirate of bubbles. We've never had 3 bubbles existent at the same time. So we had the NASDAQ bubble in isolation, and then we had the housing bubble in isolation. But now we have the housing bubble, and we have a credit bubble, and we have an equity bubble, all existing concurrently. So you say, well, you can reinflate asset prices, and you create more deformations in the economy. On the other end of that, you have a bust that again has to be papered over. And every time you do that, the busts get more amplified and the destruction becomes more intense.
Would you say that the main culprit, it seems, is just never-ending deficit spending by the U.S. government?
That's where it starts, Aaron. Very astute of you. So it starts with, if we had real money, and if we had gold-based money, and we had banks that weren't allowed to go, hog wild on the fractional reserve system because we allow them to fail, under a gold regime, you'd have the base money supply grow commensurate with population growth plus productivity growth, which is around 2%, which is about the money supply of gold increase every year. So you don't have these bubbles. But since the Treasury is not fettered by any restriction on the amount of base money supply, and the private banks blow that up even more with the fractional reserve system, you have these bubbles. So it's the Treasury that spends a lot of money. If they had real honest money, interest rates would soar, which would act as a governor to how much money they could spend, but we don't have that anymore. So you have the Treasury, the private banks, and the Federal Reserve all acting together to destroy the middle class, and they've been very successful.
Obviously, the U.S. has the world's reserve currency, but it's happening all over, at least the Western world. The one thing, Trump, he campaigned on reducing deficits. I know he's only been, back in office for 3 months. At least so far, there's no real sign of deficit reduction, at least not, in this fiscal year for the U.S. government, which I think is 6 months deep now. So he's been in power for half the time. The U.S. is on pace for, I think it's a $2.6 trillion deficit this year. That's almost 10% of the country's measurable GDP. It just seems like this U.S. never-ending deficit issue is like an unfixable problem. The debt is an unfixable problem. It's only going to get worse until the U.S. dollar is no longer the world's reserve currency. I hate to be doom and gloom, but it just seems that way. The last surplus was 25 years ago. Is this an unfixable problem, I guess, is what I'm saying?
Well, it's worse than when you say it's 10% of GDP. It's 50% of all of our revenue. You can't tax GDP. I don't know why. I don't know why people always. I'm not blaming you. I'm just saying. I'm pointing out. People say it's deficit is this percentage. Well, GDP is not available, usurped or co-opted by the government. It's revenue. Revenue is very static. It's very hard to change that. You increase taxes too much, you get less of it. And if you lower tax rates close to zero, you get none of it. You get no revenue. So revenue is around $5 trillion a year. And as you said, so it's 50% of all revenue. And if you add in, entitlement spending, mandatory spending, it's 100%. So you ask what's going to happen here is eventually we're going to hyperinflate, in my opinion, just like every other fiat currency has ever done before. We'll lose the world's reserve currency status, and it's going to be replaced in a big proportion with gold. When you have intractable inflation, when it runs so high that the population revolts and says, this is enough, we'd rather have the depression than this inflation. We're not anywhere near that yet. But that's what I think eventually what it's going to come to. Because, really, when you think about it, Aaron, what politician has the bravery to say, okay, we're going to have a depression because of these imbalances that were created even before I came into office. The debt is too high. Asset prices are way out of reach. We've destroyed our middle class. What we need to do is have a period of a depression. It would be a severe one. But on the other end of that, maybe in 3-4 years, we have stable prices, a stable currency, low taxes, low interest rates, stable interest rates, maybe a slight disinflation. Those are all wonderful ideals. But we can't get it. What we're doing now is it's not something that's never been tried before. I'm not out on a limb on some hypothesis as what's going to happen or what could happen. Throughout history, what happens when you run these kind of debt and deficits and you're monetized by a central bank? The currency just gets destroyed. And that's what you're seeing in the gold market.
I'm in the same camp. I mean, I think it's just a matter of time for the U.S. dollar to lose its status as world reserve currency. But if we say gold's the new world's reserve currency, hasn't in history, whoever has the gold dictates what the currency is going to be. Like, let's say, for example, and I'm not saying this is going to happen, but let's say China has the most gold. They come out and say, we have X amount of gold, more than anybody in the world. How do they take advantage of that as a sovereign nation who wants to be, the global superpower? Wouldn't they have to start issuing their own currency and people would have to start trading in that globally?
First of all, who knows who owns what? Because a lot of people store their gold in the United States. A lot of countries store their gold in the United States. And that's another reason why you see a lot of gold flying around the world here, because people want their gold. Countries want their gold back in their own possession. The way to do it, I would imagine, is just to have your currency linked to gold and have every other currency just erode and just disintegrate.
Right.
That would be the way I think it would happen.
Yeah, this is getting a little bit off topic, but I'm genuinely interested because governments naturally have a penchant to want to control things, to have more power, to have more influence, whether it's domestically or abroad. Eventually, they're going to have to increase that money supply in order to do that, right? Like, so I just wonder how feasible a gold standard is these days. I believe in it. I just wonder for a government, I don't think it's...
Well, it would be used as a temporary weapon. I mean, you can...
Right.
China links their renminbi to gold, and every other currency that, especially a country that doesn't have the gold, their currency would get destroyed. And then after that happened, be similar to what we did after Bretton Woods. You know, we had all the manufacturing, all the gold, all the wealth, and then look, what did we do with it? We squandered it in a matter of a few decades. So I think the same thing would happen with China or whoever, or whatever nation has all the gold. China in this example, after they use it as a weapon, if they weaponize that, then they can go back and say, okay, now we have a fiat currency, we have a tool.
Right.
We repeat the process. That's why it's so imperative. This is, why I started my firm to begin with, is because, the buy and hold 60-40 portfolio just doesn't work anymore. It's just not a credible thesis of how to invest. Because when you have both stocks and bonds in a bubble, both those prices crash and bond yields rise and stock prices crater. Where is your offset? Where's your ballast? Yeah, you have to diversify. You have to be able to raise cash, own commodities, be able to own into gold, be able to short the market. All those things have to be in play if you want to have a successful and viable retirement. That wasn't the case in the 50s or 60s or even a part of the 70s. It's just, even in the 90s, we're okay. We jumped the shark as a nation in 2000 when we had the NASDAQ collapse. We should have just let it happen. It devolved and morphed and metastasized into, hey, we can't let banks fail anymore. You remember in 2020, 2023, we had a few banks fail? The Fed sprung into action immediately. Failure is a part of life, and some things deserve to fail. And that's just not businesses. It's part of life too. We shouldn't keep things on life support. There's businesses that need to fail.
Yeah.
We should let them fail. And there's banks that need to fail.
Why do you think the Fed stepped in 2023? They were afraid of bank runs and the contagion of the potential event? Or why?
Yeah.
What happened there?
Exactly.
Paranoia?
No, it's not paranoia. It's just recognizing the fact because of the fractional reserve system. Your money is not in the bank. The bank has a very small percentage of the money that they claim that they have. So if you get a run on the bank and you say, I am taking my money out. I mean, you go watch reruns of A Wonderful Life. I'm taking my money out of the bank. Well, if everybody did it at once, the bank has to liquidate assets, fire sale prices, which exacerbates their insolvency, and they're insolvent. So, the Fed has no choice at times to bail out. But when you have this inculcation throughout the financial system that nothing can ever fail, I guess the point of the matter is to stop this condition from happening in the first place. Why do we have such leverage in the financial system? That's where it begins. Stop the leverage. Like we even had a recent example where hedge funds were leveraged 100 to 1 on bets on basis point spreads in the Treasury market. And you unwind them quickly, and then you have failures in the financial system. I think we should start with keeping leverage as contained as possible. But where's the regulators? The best regulator of all would be a Fed that says, I will not bail you out. Well, this is the original construction of the Federal Reserve in 1913. They had a discount window, which meant that you could take a distressed bank. It was only banks, it wasn't shadow banks. It was a bank. A member of the primary dealers could come to the discount window, take their treasuries, not their mortgage-backed securities, not their junk bonds, take their treasuries, and they would sell them temporarily to the Fed at a discount, and the Fed would give them money. So the Fed was always protected. And it was a big stigma on that institution. But now it's morphed into, hey, you know what? If there's a problem, hey, send us all of your bad assets. We'll take them off your balance sheet and keep them there forever if we have to.
Let's say, just going back to Trump real quick, I'm trying to find a green shoot for the U.S. economy. If we go back to Trump's tariff plan to, turbocharge reshoring like he says it will, my concern is that won't it just kind of torpedo global demand for product? Like, because values are going to go up so much for a lot of these products. The reshoring, I think, will probably take 5-10 years, like if it works at all. Do you think Trump's plan can actually work within his term?
Okay. The answer is, unfortunately, no, especially the way the implementation has been so chaotic. Take, for example, Vietnam. So Nike makes their sneakers in Vietnam. The average worker in Vietnam makes $3,000 a year. The average worker in the United States makes $35,000 a year. So what kind of tariffs would you have to put on Vietnam to make that right? And I'm not talking about I'm talking about just wages. I'm not talking about other non-tariff barriers. What Trump would have to do is put an enormous tariff on sneakers made in Vietnam, and it has to stick. In other words, I, as a business owner, would have to understand this is the tariff rate, and it is not going to change. We've had nothing like that. We've had a certain percentage in tariffs, then they escalate, and then there's exemptions and there's carve-outs. There's no way you can change behavior in 4 years if you're going to have this kind of deviation from his plan. So no, the answer is no. You're not going to. But again, rebuilding the middle class, rebuilding our manufacturing base, balancing trade is a noble idea. It has to happen. I mean, maybe there's some other way to do this. Maybe I could suggest to the president, say, listen, if you have a trade deficit with the United States, we're not going to rebalance that with tariffs. You are now on the hook to make sure you buy X amount of dollars of our goods, whatever it is. And if you don't, you owe us that money. I'm just spitballing here, but if we sell you a very little bit of corn, you're exporting us a massive amount of toys. You have to buy something else from us to balance the trade. Maybe it doesn't have to be perfectly balanced, but that's better than these tariffs because it's not going to do anything for the middle class. It's going to hurt them with rising prices. It's not going to rebuild our manufacturing base, and it's not going to balance our trade deficit.
This is something I really wanted to ask today, is I know you kind of already pegged the U.S. economy to be in a recession. I agree. It certainly is in much of the Western world. Given everything we talked about today, all the pending threats economically with the dollar and so forth, and the fact that, the old buy and hold model may not necessarily work very well anymore. But I also think that, the average investor at home doesn't have time to rebalance their portfolio, potentially take a short position, and they don't have the expertise to do it. I think the average investor right now today who's paying attention, but, obviously isn't a professional like yourself and doesn't do it as a full-time job, I think they just want somewhere to hide. Where do you hide in this type of environment?
So if you can't find an active manager like myself, or you don't desire to do so, I think T-bills still provide a very good ballast for stock prices. So your T-bills and gold will get it done for you. Of course, it's better to be able to short the market when it's crumbling. And then how do these people know when to get out of that allocation? Well, I spent 30 years developing an inflation, deflation, and economic cycle model, an algorithm that lets me know. I mean, I was out of the market. I only had about a 10% exposure to equities in December of 2024. And the reason why I knew to do that is not because I anticipated a 15% drawdown in the S&P 500. I did not. But I knew that the risk-reward ratio wasn't there owning equities over short-term bonds. It just wasn't there. That was my assumption. And that saved having a pretty good year where everybody else is down between 15% in the S&P and 25% if you own any of the Mag 7 complex there.
Yeah.
So having an active manager that knows how to short the market and knows when we reach the nadir, when you can go long, when it's safe to get back in the market, is essential for your retirement. If you're just stuck in the 60-40 portfolio and you're close to retirement or in retirement and you lose half of your money, the average recession, the market goes down, I think 35% around that. This is not your average recession because asset prices are starting from such a higher elevation. We didn't even talk about really the housing market, it's going to destroy banks' abilities to make loans. This is the housing market that looks a lot like 2008. Yeah, much better underwriting standards than 2008, but 3.5% down in FHA secure loans. The dollar amount of those loans are up 1,000% since the global financial crisis. And what about the fact that you have 25% of investors that own properties now, not owner occupied? And the fact that Treasury yields are rising and mortgage rates are tied to long-term Treasury yields. So you're not getting any relief in the mortgage market, as you usually would at this time when you see a crashing GDP growth. It's very important to have an active manager, but if you can't, just sit in T-bills until you think it's over.
Right. Are you still essentially out of equities for the most part?
I have a very small position in low volatility U.S. equities, and I just took a position in India today. I think what Trump is going to settle on doing, because his Liberation Day rates on the rest of the world just didn't work. The stock market wouldn't let him hold to those strictures. So I think he's going to settle for a 10% tariff on the rest of the world, or most of the rest of the world, and just try to isolate China as most as possible. One of the great beneficiaries of isolating China would be India. But it's a small position. I'm not really long stocks. I have shorts in the portfolio. I have low volatility stocks. I have gold, and I have a lot of T-bills. That's what the model calls for me to be in right now. I run the model every day, so I could change by the time this airs. But
Of course.
that's the current position as of Tuesday afternoon.
Michael, I really appreciate your time. This has been a great conversation. I'm not feeling too optimistic, but I do appreciate the educated caution that you do provide. So where can our viewers find you online? Tell us more about Pento Portfolio Strategies.
So the website is pentoport.com. On it, you'll see something called the Midweek Reality Check, which is a podcast that I put out every Wednesday evening. You get my 36,000-foot view of what's going on and the unbiased interpretation thereof. And if you have $100,000 to invest and you're a U.S. citizen and you qualify for the portfolio, in other words, you want to own something that's long, short, and not just pegged towards the S&P 500 with some bonds, depending on your age in the portfolio, I'll manage your money directly in the inflation, deflation, and economic cycle model.
Well, Michael, will include for our viewers a description in the link for all of that, as well as your socials. Just want to thank you again for joining me today. I appreciate it.
Good to be with you, Aaron.